Good morning, ladies and gentlemen. 안녕하세요. 금융투자협회 조사국제부 류정선 과장입니다. 오늘 웨비너 발표는 영어로 진행될 예정이나 다수의 참석자분들께서 국내분임을 감안하여 저는 한국어와 영어를 병행해서 진행하도록 하겠습니다. 오늘 개최하는 저희 금융투자협회 글로벌 투자동향 제3차 웨비나는 BCA 리서치에서 Reflation or Bubble, 기관 투자자의 글로벌 자산 배분 전략을 주제로 발표해 주실 예정입니다. 2020년 하반기에는 경제 성장률의 강한 회복과 통화 정책의 긍정 신호에 힘입어 금융시장이 계속 랠리를 이어가고 있었지만 최근 들어서 다소 조정되는 모습을 보이고 있습니다. 이에 따라 이번 웨비나에서는 BCA 리서치의 수석 글로벌 자산 배분 전략가인 게리 에반 씨를 모시고 투자자들은 어떠한 포지셔닝을 취해야 하는지 분석해 보도록 하겠습니다. 발표 중 질문이 있으시다면 Q&A에 써주시기 바라며 발표가 끝난 후 Q&A 세션에 최대한 답변 드리도록 하겠습니다. 그럼 이제 본 발표에 앞서 근본 웨비너를 공동 주최해 주신 BCA 리서치의 박민우 팀장님께서 인사 말씀을 드리도록 하겠습니다. Mr. Park?
Hey, thank you, Teresa. 안녕하세요. 저는 BCA 리서치에서 현재 한국 영업 총괄을 맡고 있는 박민우라고 합니다. 아마 이미 대부분 BCA를 아시는 분들이 접속을 하셨을 것 같아서 소개글은 생략을 하고 바로 발표자 양력을 소개를 해드리도록 하겠습니다. 최근에 아무래도 매크로 요인이 좀 강한 장을 경험하고 계시기 때문에 또 오늘 세미나로 많은 분들이 또 좋은 인사이트를 얻어 가셨으면 좋겠네요. 또 BCA 리서치 게리 에반스 오늘 이제 발표자로서 하는 분 같은 경우는 2015년도에 BCA 합류를 했고요. 또 이제 글로벌 자산 배분 전략의 치프 전략가 학과 같이 또 회사 임원을 같이 겸임을 하고 있습니다. 또 BCA 이전에는 이제 HSBC에서 글로벌 헤드를 이제 역임을 하고 이제 홍콩이나 일본 그리고 APEC 전략을 이제 전문으로 하고 있었기 때문에 오늘 자산 배분 전략에 관련돼서 이제 혹은 또 이제 아시아 시장 관련돼서도 많은 답변을 드릴 수 있을 것 같습니다. Gary, over to you. You can start with the polling questions now.
Great. Well, thank you very much for joining me this morning, and thank you for those introductions. So I'd like to start with 3 polling questions to get some idea of what you're thinking about the world at the moment. And let me just start with the first one, asking you, what do you think will be the level of global equities at the end of this year? And this gives you, this chart, some idea of the sort of numbers that we're talking about. So hopefully the poll is now on the screen. So will equities be more than 15% above the current level? So here, 5 to 15% above, 5% plus or minus from the current level, more than 5% below, or more than 15% below. So hopefully you can see the poll on the screen. You just need to click on the places that you think make sense. So where do you think the level of global equities will be at the end of this year? So please just choose one of these. And we'll give it about 30 seconds to allow you to think about that. And have a look at the chart behind. Hopefully you can still see that as well. That gives you some idea of what we're talking about. About half of you have voted, so give it a little bit longer so people have time to think about this. Another 5 seconds maybe. And let's stop it there. Thank you very much. So moderately bullish, but not excessively so. So most common response, slightly more than half people expecting a little bit more of a rise, so coming to here. Interestingly, almost nobody is expecting a significant decline. So let's move on to poll 2. So I hope you got those results there. So those are results. So poll 2, what do you think will be the level of the US 10-year Treasury yield? Obviously something that's been in the news recently by the end of the year. Above 2.25%, so right up here, 2 to 2.5, 1.5 to 2. So we're currently today at 1.53 or so, 1 to 1.5 or below 1. And I think some of you may have voted on this already. I apologize, these don't seem to be coming out separately. So hopefully you can now see on the screen question 2. So just look at question 2 for now. Where do you think the 10-year Treasury yield will be at the end of this year? So please just choose one of those. Give it another 5 seconds or so. Let me end it there. So hope you can see the results in question 2 now. So most people think it's actually going to be quite a bit higher than today. So nobody thinks it's going down from here. And in fact, 2/3 of the respondents think it's going to be over 2%. So more than another 50 basis points up from where we are now. So then the third question, what about inflation? Obviously linked to that, core PCE inflation in the US, which is the one the Fed focuses on, is currently 1.5. Do you think in 12 months' time, that's quite important, so March 2022, where is core PCE inflation going to be? So I'm going to try and make this work again. So just question 3 this time. Where do you think core PCE inflation will be in 12 months' time? Above 2.5, so real takeoff of inflation, 2 to 2.5, 1.5 to 2, so slightly higher than now, or below 1.5. So I'll give it another 20, 30 seconds as before. Still a few. This is probably a trickier question. Maybe you have stronger views on the bond yield and on equities than you do on inflation. I'm not sure the Fed even would find this a particularly easy question to answer. So give it a little bit longer. We've not got that many people voted yet. So another 5 seconds maybe. So let's stop there. And so for that one, we've got, well, nobody thinks it's lower than today, and half of the respondents thinks it's between 2 and 2.5, but nobody thinks it's over 2.5. So I think that's an interesting set of results. I would take that to read that people are sort of cautiously positive. They see a moderate pickup in inflation, but nothing too dramatic. Moderate pickup in interest rates, nothing too dramatic, which will lead to reasonable further gains from equities. So that's probably, I think, a good description of where the consensus is now. So what I would like to talk about for the next maybe 20 to 25 minutes is just to give you a quick overview of how BCA sees the world and our market recommendations for the next 12 months. And it's a fairly optimistic forecast. We see growth rebounding in the second half of this year. But despite that, we think everywhere around the world, fiscal policy will still be quite accommodative, and central banks will not move towards raising rates or ending QE. Eventually, however, and it's probably more like 2023, inflation will rise, and that will be the thing that will eventually kill the expansion, but not for the next 12 to 18 months. So for now, we continue to be overweight on equities, have a fairly pro-risk tilt with preferences to growth stocks, cyclicals, etc. But I would advise that inflation is going to become a risk at some point. And so thinking how to hedge that is, I think, an important way of putting together a portfolio at the moment. So the macro picture starts with the assumption that in Europe and North America, the vaccination program is progressing pretty well. We've got now, for example, over 35% of people in the United Kingdom have been vaccinated. You can see on the right-hand chart that the current rate, the US will achieve herd immunity with 70% of people having had 2 doses by something like June this year. And that should mean that people are able to go out again. Lockdown restrictions will be released, and there's a huge amount of pent-up demand for consumer goods out there. If you look at the way savings rates have moved, you can see from the left-hand chart that in the US and in Europe, savings rates are 17 to 20%. And we estimate on the right-hand chart that in the US, there's excess savings of about $1.5 trillion. That's about 7% of US GDP, because people have not been able to go out on vacation, go out to restaurants, etc. And that should be spent to a degree once the lockdowns end later this year. The message from fiscal policy is that governments are still pretty accommodative, and it's worth remembering just how big fiscal policy has been. If you look, so these have lost their labels. I think the left-hand bars here are for the US, The green bar is the amount of stimulus that was done during the global financial crisis in 2009 to 10. The black bar is what the US did last year. The gray bar is what it's doing now for this year. And this week, we should see 1.9 trillion pass through the US Congress, in addition to the 900 billion that was passed in December, and another 2.2 trillion that was done back in April last year. So those all add up to 25% of GDP, 5 times the amount of stimulus that was done in other countries in the global financial crisis. And I'm sorry you can't see the other countries, but you can see the point is that everywhere around the world is doing stimulus that is much bigger than it was in the global financial crisis. And there seems at the moment to be no appetite to slow that. Inflation in the short term is certainly going to rise, simply because the year-on-year calculation will start in March and April to have a very low prior year comparison. So we are likely to see headline CPI in the US, which is currently around about 1.6%, perhaps spike to as high as 3.5% over the next 2 or 3 months. You can see from the left-hand chart that we've also seen a sharp rise in crude oil prices. The US dollar has depreciated. All those things mean that inflation will rise in the short term. In the second half of this year as well, you can see from the right-hand chart that once the economy is opened up, people are able to go out again to spend money in restaurants, on holiday, the price in services is going to start to rise as well. So also in the second half of this year, there should be a moderate uptrend in inflation. Now, the Fed says this is temporary. The market, I think, should believe that, because on a longer term basis, on the next 12 to 18 months, it's hard to imagine that overall inflation is going to trend up when we have a labor market that is as weak as it is currently. On the left-hand chart, you can see that US unemployment is now down to 6.2%. But the Fed is saying that if that were calculated properly, it's actually more like 10%. And if you look at broader measures of unemployment, on the right-hand chart, for example, you have the employment to population ratio for the prime age workers. And you can see that is still hardly any better than it was at the worst point in the recession in 2010. Something the Fed is also very conscious of is that we have a K-shaped recovery. For many segments of society, the economy still seems absolutely terrible. You can see, for example, on the left-hand chart, that for high wage earners, employment has now recovered back to its level previous to the pandemic. But for the low wage earners, and the Fed is very clear, this means Black and Hispanic workers, employment still looks very, very poor. And you can see, for example, from the right-hand chart, which is an interesting survey done asking people, how did your personal circumstances change during the pandemic? The right-hand bars for people earning over $100,000 a year, actually the pandemic was a net positive. But look at the poorest groups in society, or people who didn't go to college, or women, and the pandemic still seems to be very painful. So the Fed is going to find it very hard to tighten in that environment. Now, the Fed has been very clear the criteria it wants to see before it moves to any monetary policy tightening. They're the items in that table on the left. And the one in the middle, the employment market being back to a level of maximum employment, seems to us extremely unlikely we will see until at the very earliest, the end of next year. And then as far as inflation is concerned, in the new framework for monetary policy that the Fed announced last August, they've emphasized that they want to see inflation overshoot their 2% target. So I showed you this chart earlier when we were doing those polling questions. The Fed now says that that green line, the 12-month moving average of PCE inflation, should be over 2% and should be on track to moderately exceed it for some time. So we're still a very long way away from that happening. So that says to us, the Fed is not going to move towards tightening at any point. Now, obviously, in the last few weeks, we have started to see long-term interest rates rise from 90 basis points for the US 10-year at the beginning of this year to now about a bit more than 150 basis points. We think it's unlikely they're going to go very much further than that. And I would say there are 2 reasons for that. First of all, if you look at what the market has priced in for the date of the first Fed rate hike, it's on the chart on the left. The futures market are now pointing to the first rate hike in the 4th quarter of 2022. So logically, for long-term bond yields to rise, the market would have to start to price in the Fed is going to move even earlier than that. And it seems to us, from what I said earlier, that's very unlikely. The other possibility is that the inflation component of bond yields rises further. And if you look at the right-hand chart, this is the implied inflation that you can get from the TIPS break-evens. It has risen very sharply recently, and it's now about 20 or 30 basis points below an equilibrium level that would be compatible with the Fed achieving its 2% target. So I think it probably goes back to where those dotted lines are, but probably then stays at that point. So it says to us, therefore, that probably we might have another 20 or 30 basis points further upside for the 10-year bond yield in the US, and also therefore government bond yields in other developed countries, but not much more than that. So should we worry about a rise in long-term interest rates, which people always do when they rise? But actually the history is fairly clear. If you look at the left-hand chart, we found that there were 8 episodes of sharply rising bond yields going back to 1990. And in all but one of those instances, equities performed extremely strongly during the period when the bond yield was rising. The only exception was in 1993 and 94, and that was because in February 94, the Fed raised rates very surprisingly. They hadn't warned the market that might happen. And you had something like a 6-month correction in equities. But even in that episode, within 6 months, equities were back to their previous level. The only risk is if the correlation between bond yields and equities breaks down. You can see from the right-hand chart that over the last 20 years or so, typically when bond yields go up, equities go up. There's a positive correlation. But prior to about 1990, the correlation was usually negative. So if bond yields are rising because growth is strong and is picking up, that is obviously a positive for equities. The problem would come if bond yields start to rise because inflation rises strongly. I don't see that happening yet, but I think it will happen eventually. Now, that story I've just told is all very well, but we've had a very strong rally in equities over the last 10 months. How much of that is already priced in? Is the equity market getting too bubbly? And there are certainly parts of it that are. If you think of what happened in January and February with the run-up in stocks like GameStop in the Reddit chat channels in the US, I think you had a similar phenomenon in Korea. There's certainly signs of bubbliness. On the left-hand chart, you can see the put-call ratio in the US. And what that tells you is that there are not very many people buying put options and lots of people buying call options. That ratio is the lowest it's been for close to 20 years. But what I would emphasize, though, is although there are quite a few speculative investors out there, the cash that was put into the system last year by the Fed is still stuck in bank deposit accounts. You can see on the right-hand chart there that there's still a very large amount of cash sitting on the sidelines in money market funds and bank deposits. You might also complain that equities look very expensive, and certainly you can see from the left-hand chart that the forward PE for the S&P 500 is close to the peak that it reached in the tech bubble in 2000. The difference today, however, is if you look at the right-hand chart, where bond yields are, the green line shows you real 10-year bond yields. And in 2000, when equities were this expensive, the bond yield was at 5% in real terms. The Fed was raising rates. By February 2000, the Fed had raised rates 3 times. Today, the real bond yield is -1%, and the Fed is still a long way away from raising rates. So the gap between those 2 lines on the right-hand chart is, if you like, a proxy for the equity risk premium. So the gap currently is about 5%. In history, the gap has been 3.5%. So although equities are expensive in themselves, they are quite cheap by historical standards relative to bonds. So how will this all end? Framework I've always found useful for thinking about cycles is this one. If you look at the top left-hand chart, this shows you the green line potential trend growth in the US, with the black line where GDP is actually. And what happens at the beginning of an expansion is that GDP is running below potential, which means you can have a period when there is strong growth, but it's not inflationary. And you can see the chart below is just the gap between those two lines. Typically, you get a recession, which are the gray areas, about 2 or 3 years after the output gap turns positive. And that's because it produces inflation, and either the Fed puts its foot down and stops the inflation, or it doesn't, and that causes an asset bubble, as in 2000 or 2007. And that bubble bursting is what ends the expansion. So the warning I would give is the expansion this time might be quite short-lived. If you look at the right-hand chart, this is where we are today. The output gap in the US is about minus 2.5% of GDP. But with the huge stimulus, with the likely big pickup of GDP in the second half, the consensus amongst economists is expecting that output gap to close by the end of this year. So that is compatible with the view I expressed earlier, that maybe in late 22, in early 2023, we might see inflation coming through. So a few thoughts on recommendations where you should invest. One key to always think about is, where is the US dollar going? It has depreciated about 10% in trade-weighted terms over the last 10 months or so. We think it's got further to go over the coming year. One of the things that drives currencies is the relative interest rates, the interest rate differential. The gray bars in these two charts on the left are dollar bull markets in history. And you can see that they've all periods when US interest rates in real terms were rising relative to real rates in other developed countries. In the last year or so, US rates have fallen. And the world I explained earlier, where US inflation eventually picks up, but long-term rates do not rise very much, is one in which US real rates continue to decline. The other thing to say about the dollar is it still is quite expensive relative to purchasing power parity. You can see from this chart that in the long run, currencies, and it's true for all major developed countries, do tend to mean revert to the PPP. But when they go to PPP, you can see they tend to overshoot. So our view is therefore the dollar is likely to continue to fall, perhaps another 10% over the next 12 months or so. So this is a snapshot of our recommendations currently. Overweight equities, have a preference for US equities over other developed markets, have some selective stocks within emerging markets that we like. And I won't talk about it today, but there are some pockets within credit, particularly emerging markets, sovereign US dollar denominated debt, and the high end of junk bonds, high end of high yield that we like. I just wanted to talk about a couple of those. The first is our preference for the US. And that partly comes down to the fact that US growth looks significantly more robust. If you look at the two charts on the left here, these are the PMIs for different regions. The black line is the US. You can see both manufacturing and services look pretty strong in the US. By contrast, look at the green dotted line, which is the Eurozone. Manufacturing looks strong, but services look terrible. In the case of Japan, the brown line, manufacturing is okay, services again are pretty poor. US hasn't had the same lockdowns, but what I would emphasize is that the fiscal and monetary easing has been much more aggressive in the US. And if you look at the right-hand chart, you can see the impact of the Fed's big increase in its balance sheet last year, which was twice the increase that the ECB did, means that money supply growth in the US, M2, is running at about 26% a year, compared to only about 10% growth for the Eurozone and Japan. A key issue is obviously the big debate between value stocks and growth stocks. I won't go into it perhaps in much detail. My view, and this is something we've debated at length within BCA, and some of my colleagues don't agree with me, my view is that the value outperformance we've seen really in the last month or so is probably not going to continue. When you boil it down, value versus growth means essentially bank stocks versus tech stocks. And what they're both very sensitive to is interest rates. You can see from the right-hand chart that bank stock prices performance in relative terms is highly correlated to the shape of the yield curve. So with short-term rates pegged, what that means therefore is, where do long-term rates go? And as I argued before, I don't see them going up very much. And for growth stocks as well, when they discount earnings long out into the future, that means the fair value is highly sensitive to the discount rate that you use. So that's the risk-free rate. And so a rise in bond yields would be good for banks and good for tech stocks. I think, therefore, it's unlikely. And I would, given the sell-off that we've had in tech in the last 3 or 4 weeks, would actually be looking for this as perhaps a new entry point. Finally, inflation. It is going to come in the long run. I think probably in 2 or 3 years' time, the Fed will have lost control of inflation. We think there are some strong structural reasons to expect rising inflation, demographics, slowdown in globalization, etc. So what do you do to hedge your inflation risk? And my service produced a big report 18 months ago on expectations that inflation would eventually come through. We looked at the data going back to 1970. The dots in that left-hand chart show you periods when inflation was rising, either at high levels or moderate levels, etc. So the key were the results in this right-hand chart. Which sectors, which asset classes performed well? When you get inflation that is rising but is still mild, so up to about 3.3%, equities continue to perform quite well. And I think that's a key thing to remember. So when we go over 2%, and you remember in that polling question, nobody thought inflation was going over 2.5%. I would agree with that. Equities should still outperform in that world. If maybe in 2023, we start to see the Fed losing control, inflation goes to 3, 3.5, 4, that is when you need to start thinking about tips, inflation-linked securities, commodities, gold, and even being very defensive in your equity portfolio. What about gold? The warning I would give on gold, though, is it's very expensive. I know it's an asset class a lot of investors like. It's hard to value, but there are a few things you can look at. For example, look at the real value of gold. So take the gold price and deflate it by US inflation. And when gold was a good hedge against inflation in the 1970s, it started from a very low level. Today, in real terms, gold is almost at a record high level. Cryptocurrencies. I am very skeptical about the advantage of cryptocurrencies. Fun thing to play, they may well go up, it's a gamble. If you look at the volatility of Bitcoin, for example, you can see on the left-hand chart, it has a volatility almost 3 times that of small cap equities. So a great thing to speculate in, to me, not an asset class that an institutional investor should be looking at. I really don't see an attraction for cryptocurrencies as a store of value or as something you can actually use. If you look at the right-hand charts, the liquidity of Bitcoin is extremely poor. It's really hard to transact it. And the cost currently is about $30 per transaction. Eventually, if cryptocurrencies take off, I think what will happen is central banks will create their own using blockchain, and use of non-public cryptocurrencies, non-official ones, will be banned. You can't stop people owning them, but you can stop businesses taking them. So I would be very reluctant. Cryptocurrencies seem to me a classic bubble in a world when there's a lot of liquidity. Emerging markets, I do think selectively look attractive. I won't go into this in detail, but the left-hand chart you can see, particularly compared to the US, emerging markets look very cheap. I would be a bit selective though. Some of the emerging markets have got dysfunctional central banks at the moment. So I would be avoiding countries like Brazil, South Africa, Indonesia, Turkey. Our preference is for the stronger, more advanced emerging markets, including Korea, Taiwan, and for the energy-related ones like like Mexico and Russia. The key thing for emerging markets, you look at the right-hand chart, is US financial conditions. When US financial conditions are easing, so that means US rates are not rising too much, the dollar is weak, that's positive for the emerging markets. So that is the environment that I would see, a weaker dollar and not too much of a rise in US rates. And finally, for emerging market currencies, the thing to think about there really is commodities. If you look at the right-hand chart, you can see that there's quite a strong correlation between industrial commodity prices in particular and emerging market currencies. And the thing that you need to bear in mind there is what China is doing. So let me just finish with one page on China. I'm a little bit concerned at the moment. There are some signs coming through that Chinese economic growth is slowing. The thing to look at always for China is the credit impulse. Every time there's an economic slowdown, the Chinese government turns on the liquidity taps, pushes banks to lend, and that green dotted line is the annual change in credit in China as a percentage of GDP. And you can see last year a massive increase in credit. That impulse has started to slow. and activity typically follows behind that with a lag of about 6 months. So that says probably that growth is going to continue for a while. But some of the recent data, if you look at the right-hand chart, for example, you can see that export orders, the new orders in the PMIs have started to slow in China. Obviously, at this time of year, that data gets muddled by the Lunar New Year holidays. But nonetheless, I think there are some signs the authorities are moving back towards being more concerned about debt, trying to slow down the bubble in property, and taking a little bit of a foot off the accelerator in terms of liquidity. So emerging markets only selectively be that moment. We'll have a sort of neutral view on emerging markets. So let me stop there. Probably talked a little longer than I should have done. I will stop sharing my screen and very happy to answer your questions.